You check the market like it's a heartbeat. One green day, you feel unstoppable. One red day, you feel like a fraud. And nobody talks about that part. Because the real damage isn't always your money. It's your mind. If you've ever felt anxiety after buying a stock, if you've ever chased a sure thing and watched it collapse, if you've ever wondered why investing makes you feel obsessed instead of free, this video is for you. Because what you're dealing with isn't just finance. It's psychology. In this video, you're going to learn why most people lose money even when they have good information, why experts often sound smart but still fail, how your brain gets hijacked by fear, greed, and status, and how the simplest strategy, the one almost nobody respects, is often the one that quietly wins. We're breaking down the real message behind a random walk down Wall Street. Not like a textbook, like a mirror. And by the end, you'll walk away with a mental framework for investing that doesn't depend on luck, doesn't depend on predictions, and doesn't destroy your peace. So if you're tired of feeling played by the market, stay with me. Who wrote A Random Walk Down Wall Street? And why? It was written by Burton Malkiel, an economist and longtime Princeton professor. He wrote it because most people were getting emotionally manipulated by the stock market, and then calling it strategy. He saw a pattern. People wanted certainty. Markets sell uncertainty. So humans invented stories. The book is his attempt to break the spell. His core argument is blunt. Most professional investors do not beat the market consistently. Prices already reflect public information fast. So the average person is usually better off buying a low-cost index fund and holding it for the long run. The random walk idea is the heart of it. Short-term price movements are largely unpredictable, like steps taken in the dark. That doesn't mean markets are meaningless. It means your ego is, and that's what the book is really about. Not money, but human nature. Chapter 1. You're not investing. You're seeking comfort. Question. Be honest. Are you here to build wealth or to stop feeling powerless? Because that's the real reason you opened this topic. You want a method, a clean map, a way to stop being the person who's always late to the party. And the market knows it. The market is not a machine. It's a mirror. It reflects your impatience, your greed dressed as ambition, your fear dressed as risk management. Malkiel's first warning is quiet but deadly. The stock market is a place where smart people can still act stupid, because emotion moves faster than math. You think you're choosing stocks, but most of the time you're choosing a story where you are the one who finally figured it out, a story where you beat the crowd, a story where you don't have to wait. This might sound bad, but you don't want returns. You want relief, and relief is the most expensive thing you can buy. In the book's early chapters, he walks through the old financial manias, not to entertain you, but to show you something humiliating. Humans don't learn. They repeat. Different decade. Same hunger. A bubble is not just a price problem. It's a psychological infection. A group of people borrowing confidence from each other until the bill comes. And here's the twist. Even when you know it's a bubble, you still want to join. Because deep down, you're not afraid of losing money. You're afraid of being left behind. That's not finance. That's status. And if you don't admit that, the market will keep using it against you. Malkiel's point is not that you're dumb. It's worse. It's that you're human. And the market is built to punish humans who refuse to see themselves clearly. So before we talk about stocks, charts, and alpha, answer this. If the market stopped moving for 5 years, would you still feel like you had a life? Or would you finally realize you were using noise as a substitute for purpose? Because that's the first lesson of the random walk. You can't control the path, but you can control the person walking it. Chapter 2. You think you want truth, but you're addicted to predictions. Question. When you check the market, are you searching for information or permission to feel safe? Because that's the dirty secret. Most people don't read financial news to learn. They read it to calm their nerves or to fuel their ego, and the system rewards that. The world of investing is full of confident voices, because confidence sells better than accuracy. Malkiel basically says, the market is a place where prediction is treated like wisdom, even though prediction is mostly theater. You've seen it. Someone on TV speaks in clean sentences. They say rotation. They say headwinds. They say, this is a buying opportunity. And your brain relaxes, because uncertainty is heavy. But here's the problem. The more you try to predict, the more you train your mind to fear randomness. And randomness is the natural weather of markets. This might sound devilish, but the financial industry doesn't need you to be smart. It needs you to be active. It needs you to click, to trade, to rebalance every time you feel anxious, to feel like you're doing something, because doing something feels like control, even when it's just panic in a suit. Malkiel attacks this from a simple angle. If markets absorb information fast, then most obvious news is already priced in by the time you hear it. So the average investor who reacts to headlines is like someone trying to win a race by chasing the shadow of the runner. You're always late, not because you're slow, but because the game is designed that way. And the deeper you go, the more you notice something uncomfortable. A lot of investing knowledge is just vocabulary, not truth. Words that make chaos feel organized. And your mind loves that, because your mind hates admitting, I don't know, but that sentence is power. Stoics understood this. The calm person isn't calm because they control life. They're calm because they don't demand life be controllable. That's the difference. So here's the lesson of this chapter. Stop worshiping forecasts. Stop looking for someone to tell you the future. Because every time you outsource your certainty, you pay for it. Sometimes with fees. Sometimes with bad decisions. Sometimes with your dignity. The market is not a god. It's a crowd. And crowds don't know. They swing. They stampede. They forget. So ask yourself, if nobody could predict anything, would you still be willing to invest? If the answer is no, then you're not investing. You're gambling for emotional comfort. And comfort is not a strategy. It's a drug. Chapter 3. Your brain was not built for this game. Question. Have you noticed how the market can ruin your mood? Even on days you didn't lose $1? That's not weakness. That's biology. Malkiel's deeper message isn't only about index funds or efficiency. It's about the mismatch between the modern market and the ancient human mind. Your brain was built for survival in small tribes, not for watching numbers flicker like a heartbeat on a screen. So when the market drops, your body reacts like a predator entered the cave. Heart tight, thoughts racing, sleep breaking, even though nothing touched you. This is where people start making moves, not because they have new information, but because their nervous system is screaming, and the market feeds on that scream. A major psychological insight here is loss aversion, discovered through prospect theory by Daniel Kahneman and Amos Tversky in 1979. They found something brutal. Losses hurt more than gains feel good. So you don't just want to win. You want to avoid pain. And that changes everything. It makes you sell too early when you're up, just to lock it in. It makes you hold too long when you're down, just to avoid admitting you were wrong. This is how portfolios turn into prisons. Malkiel's point is simple. You can't beat a system if you can't beat your own wiring. And this might sound harsh, but most people don't lose money because they're ignorant. They lose money because they can't sit still. They need action to feel alive. The industry calls this engagement. In real life, it's restlessness, a kind of inner poverty. Stoicism calls it slavery to impulse. Nietzsche would call it weakness of will. Malkiel calls it what it is, unnecessary trading. Because the more you trade, the more you pay. Not just in fees, but in mental energy. And mental energy is your real capital. Here's a modern parable. Imagine you planted a tree. Then you dug it up every week to check if the roots grew. That's what most people do with investing. They confuse attention with progress. So this chapter isn't about charts. It's about self-command. If you can't watch your portfolio fall without panicking, you're not managing money, you're managing fear. And fear is a terrible financial advisor. So ask yourself, When you feel the urge to do something, is it wisdom or is it your nervous system begging for control? Because if you can master that one moment, you'll be ahead of most investors forever. Chapter 4: The expert is often just a better salesman. Question: if a stranger spoke to you about your life the way financial experts speak about markets, would you trust them? Think about it. They talk in certainty. They talk in forecasts. They talk like chaos has rules. And you want to believe them because doubt is exhausting. Malkiel takes a knife to this whole culture. Not because expertise is useless, but because the investing world confuses two different things: knowing a lot and being able to predict. A person can know every financial term on earth and still fail at the one thing everyone wants: outperformance. So why do experts keep winning attention? Because humans don't just buy information, they buy confidence. And the market has an endless supply of confident voices, because confidence is cheap to manufacture. Accuracy isn't. This might sound bad, but a lot of financial guidance is just entertainment wearing a tie. It's not built to make you rich. It's built to keep you watching. Malkiel describes how professional managers, even the ones with elite credentials, often fail to beat the market after costs. And the twist is painful. Even when they lose, they still get paid. Because the real product isn't performance, it's hope. This is where you need a cold philosophical lens. Machiavelli would say, power is maintained through appearances. And in finance, appearance is everything. A neat suit, a calm voice, a chart with arrows. It gives the illusion that someone is steering the ship. But markets aren't ships, they're storms. So the expert becomes a priest. Not because they know the gods, but because people fear the dark. There's also a psychological trap here: authority bias. We trust people more when they look like they should be trusted. Titles, awards, a big firm behind them, but the market doesn't care. The market doesn't reward credentials. It rewards outcomes, and outcomes are messy. Malkiel's warning is sharp. The more you rely on experts, the less you build your own inner discipline. And without discipline, even good advice becomes useless, because you'll abandon it the moment fear rises. So here's the real lesson. Don't ask, is this person smart? Ask, is this person incentivized to keep me dependent? Because dependency is profitable. If you want freedom, you need simplicity, not complexity, not 10 indicators, not daily market commentary. A plan you can follow when you're tired, when you're stressed, when the world feels unstable. That's real investing. So ask yourself, are you paying for guidance, or are you paying for emotional babysitting? And if you're paying for babysitting, you're not building wealth. You're renting reassurance, and reassurance expires fast. Chapter 5: You love the hero story, but the market loves statistics. Question: why do you remember the one investor who made a fortune, but forget the thousands who vanished? Because your brain is wired for stories, not spreadsheets. Malkiel attacks something subtle here, and it hurts the ego. We celebrate the genius who beat the market. We build myths around them. We say, they saw what others didn't. But we rarely ask a harder question: how many tried the same strategy and failed quietly? This is survivorship bias. Researchers have shown how this bias distorts perception. Because we only see the winners who remain visible. The losers disappear, and with them the evidence. Creates an illusion. You think skill is everywhere, but what you're seeing is filtered survival. This might sound cruel, but for every legend you admire, there are cemeteries of forgotten portfolios, and you don't see them, because failure doesn't get interviews. The market doesn't just reward skill, it also rewards timing, luck, conditions, and probability. Sometimes a person wins not because they're brilliant, but because the wind was behind them. That doesn't mean skill doesn't exist. It means skill is harder to measure than you think. Malkiel's logic is cold. If thousands of professionals compete with the same information, some will outperform purely by chance, just like flipping coins. Flip enough coins. Someone gets 10 heads in a row. That doesn't make the coin psychic. But your mind resists this, because randomness feels insulting. You want to believe winners are special, because if they're special, maybe you can be too. And this is where Nietzsche's idea of will meets reality. Will matters, but will does not cancel probability. The Stoic stance is calmer. Focus on what you can control, process, cost, discipline. Not glory, not applause, not becoming the next market wizard. Because chasing the hero path often leads to overconfidence. And overconfidence is expensive. Studies on overconfidence bias by Barber and Odin in 2001 found that investors who traded more frequently earned lower returns, mainly because they believed too strongly in their own judgment. They thought they were sharp. The numbers said otherwise. So let me ask you, are you building a system or chasing a legend? Are you trying to grow steadily or secretly hoping to become a story? Because the market doesn't reward ego. It rewards patience. And patience doesn't look heroic. It looks boring. But boring compounds. Heroics explode. Choose carefully. Because one feeds your identity. The other feeds your future. The video is half finished. If you like the video, be sure to comment and watch the next steps. Chapter 6. The market doesn't hurt you. Your reactions do. Question. When you lose money, do you feel pain because of the loss? Or because the loss exposed who you thought you were? This is where investing stops being finance and becomes psychology. Malkiel keeps circling one uncomfortable truth. Markets move, but you interpret. And interpretation is where suffering begins. Two people can watch the same crash. One panics, sells, and spends months replaying regret. The other stays calm, keeps buying, and barely remembers it later. Same event, different mind. This is not because one person is smarter. It's because one person trained their inner stance. Stoics knew this long before Wall Street. The event is outside you. Your judgment is inside you. And you keep confusing the two. This might sound harsh, but most investors aren't defeated by the market. They're defeated by their own need to be right. Because being wrong feels like death to the ego. So instead of adapting, they rationalize. They search for explanations. They blame manipulation. They blame whales. They blame the federal. Sometimes those things matter. But notice what the mind is doing. It's trying to protect identity. Malkiel's book points to a more grounded reality. In the short run, prices can be irrational. In the long run, fundamentals matter more. But humans don't live in the long run emotionally. They live in the next 5 minutes. So they chase, they flee, they overtrade, and they call it strategy. A psychological trap that fits here is the disposition effect, studied by Hirsch Sheffrin and Meyer Statman in 1985. They found investors tend to sell winners too early and hold losers too long. Not because it's logical, because it feels emotionally correct. It's the mind trying to avoid regret. And regret is one of the most feared emotions. This is why investing becomes personal. Because the market doesn't just test your money. It tests your character. It asks, can you endure uncertainty without turning it into self-hate? Can you watch your account drop without collapsing into panic? Can you accept being wrong without becoming bitter? Most people can't. So they look for revenge trades. They double down. They start gambling with logic as an excuse. This might sound devilish, but the market loves revenge. Because revenge creates volume. Volume creates fees. And fees create winners. Just not you. Malkiel's quiet solution is not flashy. Build a plan. Diversify. Keep costs low. Stay disciplined. It sounds simple, but simple is not easy. Simple requires humility. And humility is rare in a world that sells you the fantasy of dominance. So here's the real question. When you invest, are you trying to grow wealth? Or are you trying to prove something? Because if you're trying to prove something, the market will gladly become your judge. And it has no mercy. Chapter 7. You crave control, so you worship complexity. Question. Why do you feel smarter when your strategy looks complicated? Be honest. 10 indicators. 3 screens. A spreadsheet that feels like a cockpit. It gives you a rush, because complexity feels like control. Malkiel quietly dismantles this illusion. He argues that simple, diversified index investing often outperforms elaborate strategies after costs. Not because simple is magical, but because complexity hides friction. Fees, taxes, timing errors, emotional mistakes, they stack up silently, and you don't notice because you're busy feeling sophisticated. This might sound offensive, but many investors choose complexity to protect their ego, not their capital. If a strategy fails and it was simple, you feel foolish. If it fails and it was complex, you can blame the variables. You can say, it was a rare environment. Complexity gives you excuses. Simplicity gives you responsibility. Sun Tzu said strategy is about positioning, not constant fighting. In markets, position is allocation, not prediction. Yet people keep tweaking, adjusting, optimizing, reacting, because doing less feels passive. And humans equate passivity with weakness. But in investing, restraint is strength. There's also the illusion of control bias, studied by Ellen Langer in 1975. She found that people overestimate their influence over random events, especially when they're actively involved. You click the trade button, and suddenly you feel powerful, even if the outcome is mostly noise. That's dangerous, because the more you feel in control, the less you respect risk. And risk doesn't care about your confidence. Malkiel's framework pushes you toward diversification, spreading investments across asset classes to reduce unsystematic risk. Unsystematic risk means the specific risk tied to one company or sector can be reduced, but you resist because concentration feels bold. Diversification feels ordinary, and you want to feel exceptional. Here's the hard truth. The market does not reward how intelligent you feel. It rewards how consistent you are. Consistency is boring. It doesn't trend on social media. It doesn't make you look like a genius at dinner, but it compounds quietly. Ask yourself, are you building a system that survives you, or a system that depends on you feeling sharp every week? Because you won't feel sharp every week. You'll get tired, distracted, emotional. If your plan requires you to be brilliant all the time, it will fail. The strong investor is not the one who masters complexity. It's the one who can tolerate simplicity without feeling small. Chapter 8. Your time horizon is your real weapon. Question: why do you demand fast results from something that was designed to reward patience? Look at how you live. You want a body in 30 days, a business in 6 months, a new identity by next week. And then you bring that same sickness into investing. Malkiel's core advantage for the average person is not secret knowledge. It's time. You can hold for decades. You don't need quarterly performance to keep your job. You don't need to impress clients. You don't need to justify every drawdown with a PowerPoint. That is your edge. But you throw it away, because waiting feels like being nobody. And being nobody is terrifying for the modern ego. This might sound dark, but most people don't fear losing money. They fear being ordinary. So they trade their greatest advantage, time, for the feeling of importance. They chase. They jump into hot sectors. They buy after the hype already did its work. And they sell after fear already did its damage. Malkiel points to the long-term evidence. Over time, equities have historically outperformed safer assets, but with volatility along the way. Volatility is the fee you pay for long-term growth. And most people refuse to pay it. They want reward without discomfort. That's childish. Stoicism is the opposite. Says, accept the price of reality. Seneca warned that we suffer more in imagination than in reality. In markets, this is literal. Most of your pain is not the loss. It's the story you tell yourself about what the loss means. That you're behind. That you're stupid. That you missed your chance. But time doesn't care about your drama. Time just keeps moving. And compounding is quiet. It doesn't feel like progress in the moment. feels like nothing. Then one day, it feels like everything. There's also a behavioral trap here, hyperbolic discounting. This is the tendency to prefer smaller rewards now over larger rewards later. It's why you want the trade today, instead of the portfolio in 10 years. It's why you refresh charts like a starving person checking an empty fridge. Your brain is begging for dopamine, not wealth. So here's the lesson. Your goal is not to win quickly. Your goal is to survive long enough for probability to turn in your favor. That's how real investing works. Not through brilliance, through endurance. Ask yourself, if you stopped checking your portfolio for a year, would your life improve? Or would you feel like you lost your identity? Because if your identity depends on market movement, you're not investing. You're living inside a casino and calling it a home. Chapter 9. The greatest risk is the one you don't admit. Question: what scares you more? Losing money or realizing you never truly understood what you were doing? Because the market punishes denial, not ignorance. Ignorance can be fixed. Denial can't. Malkiel keeps returning to risk, not as a scary word, but as a law of nature. Risk is not only the market might go down. Risk is, you might panic at the wrong time. You might need cash during a crash. You might overconcentrate because you got lucky once. You might trust the wrong person because they sounded certain. This is the risk nobody puts in spreadsheets. The risk inside you. This might sound brutal, but your personality is part of your portfolio. If you are impulsive, your portfolio is impulsive. If you are insecure, your portfolio will chase approval. If you are proud, your portfolio will refuse to cut losses or admit mistakes. Malkiel explains that risk is tied to expected return. Higher return usually demands higher volatility. And volatility is not just a number. It's an emotional experience. A test of your stomach. A test of your patience. A test of whether you can stay rational while your body screams. This is why two people can hold the same investments and get different outcomes. Because one sells at the bottom, the other doesn't. And this is where modern psychology gets ugly. Studies on myopic loss aversion by Shlomo Benartzi and Richard Thaler in 1995 showed that when people check their portfolios more often, they become more sensitive to losses, and they choose safer options even when long-term risk would have rewarded them. The more you look, the more you fear. The more you fear, the worse you decide. So your phone becomes a risk multiplier. Not a tool, a trigger. Now add the modern poison, leverage. Borrowing money to invest. This is where things get devilish, because leverage magnifies gains, but it also magnifies mistakes. And the market doesn't just punish mistakes, it forces them to become permanent. Margin calls don't care about your long-term conviction. They liquidate you in the short term. So here's the warning. Leverage is not an investing tool for most people. It's an ego weapon. It makes you feel powerful, until it makes you powerless. Stoicism would call this a false bargain. Trading peace for intensity. And intensity always collects interest. So ask yourself, do you actually know your risk tolerance? Or have you just never been tested? Because everyone thinks they can handle volatility, until volatility arrives. Malkiel's deeper advice is simple. Don't build a portfolio for the person you wish you were. Build it for the person you are on your worst day. Tired, angry, stressed, afraid. Because that version of you will show up. And if your plan can survive that version of you, then you're finally investing like an adult. Chapter 10. You don't beat the market. You outgrow your need to beat it. Question. What if the real victory was never about outperforming, but about becoming untouchable? Untouchable by panic. Untouchable by hype. Untouchable by your own restless mind. This is where Malkiel's philosophy lands. After bubbles, after experts, after biases, after risk, he brings you back to something almost boring. Low-cost index funds, broad diversification, long-term discipline, and that's it. No secret door, no hidden formula, just structure. And structure sounds unimpressive, but structure is freedom. Because once you accept that markets are largely efficient, meaning prices quickly reflect available information, you stop trying to be the hero. You stop fighting noise. You stop chasing superiority. This might sting, but the obsession with beating the market is often insecurity disguised as ambition. You want to feel smarter than the crowd. You want proof. You want status. But markets don't reward ego contests consistently. They reward exposure to growth, managed with restraint. There's something almost existential here. When you stop trying to dominate the system, you align with it, like Taoist flow, but with numbers. You accept uncertainty. You accept volatility. You accept that you don't control the path. And suddenly, you don't need to. Marcus Aurelius wrote about focusing only on what is within your control. In investing, that means your savings rate, your asset allocation, your costs, your behavior. That's your territory. Everything else is weather. Malkiel's final stance is not flashy. It's adult. He argues that disciplined, diversified investing, especially through index funds, gives the average person a high probability of reaching long-term financial goals without needing constant prediction. It's not glamorous. It's durable, and durability wins. So here's the final question. If you stopped trying to win every year, if you stopped checking for validation, if you accepted that randomness is part of the deal, would you finally feel calm? Because that's the quiet twist of this entire journey. The random walk is not just about stock prices. It's about life. You can't predict every step. You can't eliminate uncertainty, but you can decide how you walk. And when you build a system that doesn't depend on your mood, you don't just grow wealth. You grow steadiness. And steadiness is rare. The market will keep moving. The crowd will keep shouting. Experts will keep forecasting. But you'll be doing something radical. You'll be standing still when standing still is required. Investing not to feel powerful, but to be free. Thank you very much for watching my video, and please like and subscribe to my channel.